Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage rates after some of the crazy events of the last few days, including the U.S. bombing Iran nuclear sites, potential July rate cuts by the Fed, oil prices, inventory numbers, and more. So hold on. Logan, welcome back to the podcast.
You know what I was doing Saturday night?
I know what you were doing Saturday night.
Chloe, get me bond dollar oil charts now. I got my 24 sunglasses on and I was like, Jack Bauer, back to work. You know, wow. It is Monday morning and a lot has happened. For those of you that read that article, I always believe in chaos. I love everything in chaos because, in chaos, you want to run to the fire and, you want to go into it. And of course, on Saturday, a lot of people said two things. Number one, inflation is about to take off. War is about to take off. Mortgage rates are going up Monday morning. The Fed can't cut rates. They might hike rates. And then you have the other camp that says, well, listen, traditionally money goes into bonds, stocks fall down big, oil shoots up higher, you go into the safety trade. So what the article that I wrote on over the weekend did it early Sunday morning without any kind of market heads up was tell everybody, hey, listen, things are going to be calm. Because things were calm in the previous week because we had so much economic data. We had a Fed meeting. We had Trump and Pulte against Powell. We had all this stuff. Not much has been happening. Not much has been happening really this year outside of Godzilla tariffs. And if it wasn't for Godzilla tariffs, the bond market would have had that extreme move down and up. And even on Jobs Friday on April 4th, when everybody was so sure we're going into recession and bond yields, I was like, we really should be at 435 today if it wasn't for Godzilla tariffs. So here we are, Saturday, bombs going off, nuclear facilities high, Jack Bauer coming back to play 24 role. And we're just going to say, listen, things should be calm unless things escalate. So Sunday night trading, oil prices up a little bit, nothing drastic. Bond yields up just a little bit, dollar. Nothing much was happening. If you did not know 3 nuclear facilities were shot and destroyed with B-2 bombers, you'd be like, okay, it's a pretty mild Sunday. Well, here comes Monday morning. And that's
wait, we have to talk about that because here we did our podcast on Friday and we're like, who knows what could happen? And we were talking about the Fed stuff and we were doing all that. I don't think that was on our bingo card. It wasn't on my bingo card that like, listen, Saturday night, we're going to be bombing Iran. And then, so you come on and you're like, how does this affect mortgage rates? Which I really appreciate. You got a really early read on it. Okay. And then comes Monday
morning. Now, again, if you did not know 3 nuclear facilities were bombed, you'd go, oh, it's a mild Monday morning. Bond yields were down just a little bit. Oil prices weren't really moving that much higher. And the dollar had nothing drastic, The 10-year yield moved down a few basis points. We got to the 435 level. And then something happened. Fed Vice Chair Michelle Bowman, who joined Team Logan on March 7th, 2025, labor over inflation. She was a hawk for a long time, and she thought we have to focus more on the labor market than inflation. She comes out and wires hit. Oh, I'm up for a July rate cut. I'm down with the homies down there. Let's talk about this. And I'm like, what? And then the 10-year yield, two of the things we thought, what could take the 10-year yield lower from 435 would be weaker economic data, weaker labor data, things missing estimates, traditionally what we've seen in the previous few years, or a Fed very dovish statement. So the civil war that is brewing within the Fed, Waller and Bowman and Sarah, who did we talk about in the last podcast?
We talked about
Bowman and Waller should be the Trump's choices, and here he is. And that took the 10-year yield lower. So here it is Monday morning. And now that even with the ISM data being better than estimates, existing home sales better than estimates, there we are. And now we could start to think maybe 12 months out, forget about Kevin Warsh or the shadow Fed. What if we just go with either Waller or Bowman, like we talked about in the last podcast, give the Fed a little bit more credibility, and then we'll take it from there. So that was fascinating. And then the first response from Iran, which we, by the way, I have so much fun. For those of you who have joined the Instagram family, it is the most views we've ever got on stories. And we're doing oil charts. And we're saying that if there is a response from Iran, usually they give a heads up and say, hey, listen, we're about to bomb, so get everyone out. That's what occurred. And as soon as that was known, oil down 8%, stock market rallying to 10-year yields at 432. This is a day for America, baby. This is a day for Americans.
Which
wow,
is
that was
really
fun.
funny considering
That was good stuff, Wheeler. This is why we do it for these kind of moments.
It's interesting that, like you said, so we bombed 3 nuclear facilities on Saturday night, and then today Iran retaliated by bombing a U.S. base in Qatar. So it's like these things don't seem like they're America first. Like we would be in a better spot afterwards. So I think that's very confusing.
It is. I honestly like. The takes people were sending me, especially with, oh my God, rates are going to shoot up on Monday rates. And I was just like, we always try to highlight mortgage spreads being a very important variable. And that's why in that article, we kind of wanted to showcase things have calmed down a lot in 2025 compared to the past few years, and even going back all the way to 2012. But in this context, when yields go up now without any stock market drama, the spreads get better, it limits the damage to the upside. And this is why even the last few weeks, not too much has been happening. It's a very, very narrow mortgage rate. So you would need some kind of event, something out of the norm, because this wasn't going to be it. And we're sitting here and just, it's not much is happening on that, considering the scope of the data.
Yes.
That Fed Vice Chair Michelle Bowman was actually the big mover. And before we did this, I think oil was at $68. I think the recent high on Friday the 13th, maybe the first time Israel attacked was at 78. The 10-year yield at 4.33. The dollar's up a smidge from the recent low. So the dollar's finding a low base to work off of. But wow, the two big cases that people were worried about on Monday just weren't happening. And we did these live stories all the way up to like 10, 11, right. 11 o'clock at night and going, hey, really, this is not much is going on, guys. So you could sleep well, tomorrow. And here we are Monday morning. God, this is where it gets fun, Wheeler. This is the good stuff.
Fun for you. Yeah. So let's talk a little bit about that non-response, because in your article, which was about, after the US bombing, what will happen to mortgage rates. In that article, you talk about the reason that you thought that we wouldn't see a big response is because it's almost like there's like headline fatigue. You don't say it that way in the article, but you talk about the fact that there have been so many things this year. In a normal year, bombing 3 nuclear facilities of Iran would have made some impact.
Let me put it to you this way. I believe traders have gotten smarter.
Okay.
Because what happened is oil prices have moved up a lot before this event and through this event. And how we highlighted it in the videos, that oil prices at $75, $76, if you look at the downtrend from the Russian invasion of Ukraine, that's hitting a key technical level. So as a trader, you're thinking, God, if I have one positive headline, this sucker's going down. So remember, traders are here to make money because they are also not the March of Dimes, right? And they like making money. So they don't really want to be on the wrong side. So they tend to get a little bit fidgety when you're like dealing with these events. So when the news came that Iran shot missiles and it's like, okay, here we go with the setup again. Everybody heads up. We're trying to save face. That was to traders a very de-escalating event, right? And then, bond yields fell. So I think traders are getting a little bit more smarter with how to deal with geopolitical events. And geopolitical events are very short term, but we didn't see the extreme reaction on either on the up or down. This doesn't mean that right after this podcast, some crazy thing can happen, but mortgage rates just doing, if you didn't know there was all these events, it would be like a normal day. Oh, Bowman came out and said, maybe we do rate cuts in July. That would be the big story. out there. So it was a pretty wild weekend. And this is why we're doing 4 times a week. And we're going to do
Yes.
a podcast on Monday to account for what's happening over the weekend and Monday morning.
Can you imagine if we had to wait a whole nother day to talk about these things? We couldn't do it.
You
We're both
couldn't do
like,
it.
we got
That's
to talk
why
about
it
it.
should be 7 days a week, twice a day, Logan 24/7. That's just how we roll.
Yes, if we could only do that. Okay, so let's talk about those mortgage rates for just a minute. I know there's some other things we want to get to, but the fact that Bowman said she's open for, July, she supports a July rate cut. What could that look like? And is the little reaction we've already seen, do you think it's going to get priced in before we even get there?
So before the year started, 2 rate cuts were already priced in.
Okay.
So now the battle becomes Jerome Powell versus America. And now America has 2 Fed presidents, a vice president and a Fed president, Waller, to basically say, homie, we don't think we need to wait. We just need to get to neutral policy and work from there. That's all it is, because 2 rate cuts were kind of already priced in the year. It's just they're moving it out, right? So there's some uncertainty that, maybe do we get any? In any case, both her and Waller were talking about basically, let's keep an eye on the labor market more. And in that context, it just means that if Waller or Bowman are going to be the next Fed chairman and the labor data gets softer, right? Because they are not a neutral policy yet. We're not even talking about accommodative policy. We're just talking about neutral. Then if the labor market gets weaker and weaker, they're already getting ahead of the curve, right? And we have a lot of Fed presidents talking this week, and we have Powell talking to Congress. Oh, that's going to be popcorn fun. I don't watch TV in that sense, but I could only imagine what's going to happen. But in this case, you can actually start putting Bowman and Waller together. And if they start talking more dovish, that is the forward guidance. That's not the shadow Fed that Warsh would have been, but this is, hey, listen, we're going to really weight the labor market. And they kind of already did that. Waller has been kind of already been doing that for some time. Bowman joined the team early. So it gets a very fascinating that this happened on a Monday with everything else going on. So boy, it to me, again, it's labor. The growth rate of inflation, the last PCE report was 2.1%. If we're talking about tariffs are going to, raise, the Fed target is 3%, right? 3%, 3.5% Fed funds rate still gets you to maybe a neutral policy in that regard. So you've got ways to go down without being accommodative or neutral. Okay. So I think that's the more sophisticated, crazy takes on the Fed and what policy is. But this is basically a strike back against Powell's kind of, we're just going to wait and see. Hey, by the way, the labor market is really bad if you're looking for a job. Tough luck. Just tough luck, because we're not losing jobs yet. And if we're not losing jobs and jobless claims are not higher, Logan Mohtashami was right about us. We are not going to do anything until, not anymore. There are other Fed presidents, and Powell's term is going to go up. So it just makes this dynamic a little bit more interesting that she came out and this came out on a Monday out there. So time will tell on that, but we have a lot of things going on here on this Monday.
We do. So I want to talk Turkey. Okay. So if the Fed funds rate, if they do something in July, are you saying that mortgage rates wouldn't move because it's already priced in? Kind of like what happened last time where everybody got their hopes up, like, oh, the Fed's going to reduce rates, and then pricing went up.
To me, we're basically, I would tell you this is the real time take. If there is a July rate cut, that means jobless claims data has gotten really bad over the next 4 weeks. Okay. And then jobs Friday at the end of June got bad. So mortgage rates would go lower before the rate cut happened. If the labor data is still firm, you're not getting a rate cut in July. Mm-hmm. But this is now not just the July talk. This is going out for many years because Powell is done. Right? Powell is done. There are already other Fed presidents getting ready to take over his spot. So we're starting to move into the next phase of the history of the Federal Reserve that Michelle Bowman, Christopher Waller, I hope it's not Warsh, and then we'll take it from there. But if you're talking about a rate cut in July, the bond market will already go ahead of the Fed if the labor data gets weaker, right? So remember, Fed meetings are too late, right? We got that 50 basis point cut is with the bond market already priced in like almost like 5-6 cuts already, so that 50 basis point was nothing, but economic data got better and yields move up. That's why we say 65 to 75% of where the 10-year yield and 30-year mortgage rate could range. It's Fed policy. Then you just flow with the economic data. This is why we do channels on the forecast. We don't target mortgage rates. We target where the 10-year yield can move within a cycle. And this always goes back to previous decade when I started incorporating them in the forecast. It was a boring forecast every year. I say, we'll just be between 1.6 and 3%. 4.5 to or 3.5 to 4.75. That's where rates. And for the most part, that's what it was for an entire decade, really.
Okay, so when is the next jobs report? So that, the one that really counts that the bond market might take to say.
So okay, it'll be at the end of it'll be in a few weeks, right? We're almost at the end of June, so we have one more jobs report. And again, jobless claims data has been slowly perking up. Nothing dramatic, but just perking up. And keep an eye on that. And then just remember, before the year started, 2 rate cuts were already priced in. So if we just get those, we're just kind of back to where we're moving down to neutral. Neutral policy, it looked like to me was 3.5% in within a 2-year period. So that's
what does that mean for mortgage rates? Like what is
that just means that you can get towards 6% easier. Okay. Right? This doesn't mean 5 or anything like that. When we start going into the 5 handles, you need the labor market breaking, you need mortgage spreads to get better. We'll cross that bridge when we get there. And this is why everyone should read the tracker every weekend, because we keep everyone updated. Think about how much smarter the people who read the tracker are than anybody else. Like we had some really smart people on X say, hey, really, I don't want to wait for these monthly reports. They're like, they're so lagging. Who do we go to for real-time data? They're like, the chart daddy. That's what he does. He is not old and slow. He looks current and forward out there. And when people get to read the tracker, they're like, whoa, there's a lot of stuff here. And it's just a current date and stuff. So we got that. And then existing home sales came out today.
There's just so much. Okay, let's stay with the tracker just for a second. I think it's interesting because one of the things, and this comes out on Saturday. So it is great because everybody can get the information before the week starts. They need to do any planning. And like you said, what you always do what to expect next week or what to expect this week. And what was the main thing you said? We have Fed people talking, listen to what they say, because that could move the market.
Yeah. With the tracker, the week ahead, it was like we have a lot of Fed presidents talking this week. So we started off with the bomb, pun intended, on Monday morning, with Bowman. So we have a lot of, I know Goolsbee picked today, the Chicago Fed. So there's a lot of things going on, and Powell's going to talk to Congress. So we got a lot of that stuff going. With the tracker, the housing data, the new listings data just didn't. It actually fell. We're running out of time. I'm happy that we're able to get above 80,000 for the first time in the last 2 years have been the lowest new listings data ever. But I really was hoping for some weeks where we were just above 80,000 and we're trending between 80 to 100,000. 80 to 110,000 was the norm from 2013 to 19. So we didn't quite get there, and we're running out of time. But again, it just shows there's not this stressed seller out there where during the housing bubble crash years, this index was running at 250 to 400,000 per week for years. It's basically really 30 to 90,000 range for the last 5 years. It will go down in history as the lowest new listings data ever recorded. But I was just hoping we get back somewhat to normal. So we did hit that normal level on the low end. We didn't get a lot of traction. We have a few weeks left, but seasonality is kicking in on our weekly data. So we're still showing year-over-year growth on our total pendings, our weekly pendings, purchase application data up 20 weeks in a row, year-over-year. We have 7 double-digit year-over-year. So there's some positive things on that. But again, the inventory data is the best story. It was very slow this week. The last week we had a holiday, Juneteenth. So I'm always a little bit skeptical of holiday data when you're working with weekly. So we'll see what happens the next week. But clearly, major sellers or forced sellers or anything like that. We're almost pretty much done for the seasonality of the year. That's just not occurring. And this is with Doge happening. This is with budget cuts. This is with Godzilla tariffs, not Godzilla tariffs, baby Godzilla tariffs, King Kong coming on the side, whatever it is. There's been a lot this year. And even with all that, Sarah, people still applied for mortgages more this year than in 2024 and in 2023. It isn't spectacular. It isn't great. But this notion that American home buyers are like these soft crybaby men on X and YouTube and TikTok and all, no, they're not, right? They can play ball, right?
I
So
do think that
it's been a fascinating year on that side.
if we were picking one movie to encapsulate this year, Godzilla versus King Kong does seem like it, just from the amount of chaos, just from the fact that there are these chaos agents fighting each other, and we're all sort of just watching, going, "Okay, where does this land?" That feels right to me.
Yeah, especially the last one where we got other monsters and crazy stuff all over the place. But I'm so. This sounds crazy, but I love this chaos. I love this chaos. Like my first thought is, I'm going to write a oil mortgage rate article before the market opens. Let's see who else wants to tackle that. Nobody wanted to touch that one, So it's just fun because this is like, you really got to like know your stuff to kind of talk about the intricacies, because anybody can make a valid case on both sides. Oh my God, the 10-year yield is going to go up, inflation is going to go up, Fed's going to have to hike rates, or oh my God, the stock market's going to crash, bond market money gets in the bonds, yields. None of them, either didn't happen. There's not much, right? And again, if you didn't know that we had bombed 3 nuclear facilities, you'd be like waking up, it's a Monday morning, not much is, oh my God, Michelle Bowman, she dropped a bomb on me, baby. Dropped a bomb on me.
Perfect song for this. Oh my gosh. So existing home sales, what did we see there?
Okay, the first thing that just made me smile more than anything, and it was funny because it was 3 years we wrote this article. The low inventory story is over. It is 100% gone. 3 years ago, I think it was June too of that month in 2022, I talked about, we have to set targets for inventory getting back to at least what we perceive to be normal. And for the NAR data, the bottom end of 2019 was a 5-decade low in inventory, but it was a functioning marketplace, right? It was a functioning buyer versus seller marketplace. So we've got to target 1.52 to 1.93 million total active inventory. And if mortgage demand stays weak, we can get there, right? The whole mortgage rate lockdown, inventory can't grow. It doesn't. No, that's not how it works. It's taken 3 years, a little bit longer than I thought, but we had 1.54. Of course, 2025, the seasonal high period, June, July, August. That's the NAR's high inventory data. That got to the bottom end of 2019. So just for all the grown-ass men running around yapping their mouths off, it's 2008, it's worse than 2008. The educated class reads, but we create charts that you could just visually see. 2005, housing sales peaked. 2007, that was an escalation of inventory, 2.5 million to 4 million. Home sales crashed from 2005 to 2008. Here, it's a whole different story. We had the fastest crash in home sales ever in 2022. Inventory never got back to the 5-decade average. 2023, inventory never got back to the 5-decade average. 2024, inventory never got back to the 5-decade average. 2025, we're still not back at the 5-decade average. However, we're at a point to where the buyers and sellers, months of supply, everything balance. This was the whole concept of team higher rates in early 2021, 2022, all the way out to 2023. It took 3 years of the weakest, lowest home sales ever recorded in history to get us here. But it's a more balanced market. It's not because we just have more choices. It's just that prices can't really escalate. And that is one way to help affordability as wages grow, price growth cools down. It reminds me a lot of the 1980s, right? The only missing element here is lower rates. And even with elevated rates, purchase application is just imagine if rates went down to 6% per year. You get something better, right? So I'm happy. It took a little bit longer than I thought, but we got to the lower end. What you would prefer is to start a year at 1.52 million and get yourself up to about 2 million. That would be preferred, but I'm going to take whatever victory I can on inventory. Home sales beat estimates just a little bit. Just remember, we've had every single month this year, the monthly existing home sales have been at 4 million or above. And for the next 5 months, it's just simply going to be such a low bar on the year-over-year sales that we're going to show growth. And because of that, take that growth in context, because we're going to have some really, really low prints to work off of.
I think when we look at inventory in for the low of 2022, which was like 240,000 for the entire country, we're what, like 3 times that now?
Well, our Altos data is a little bit different than the NERs, because we just show pure single family homes that are not in contract or anything. So our inventory data is above 828,000. The low point for our data was 240,000 in 2022. All inventory data trends the same. Everybody's got different models because they have different how they calculate. But all of us are kind of at that 2019 low end inventory levels, which means it's a more balanced marketplace. This is beautiful. If I could, I'd paint this inventory chart now. You cannot imagine how much happy I am, because we finally get there and you don't have to worry, because what happened is you cannot have a functioning housing market with active inventory that low. You just can't. Prices will still stay way too strong, and it just kills affordability out there.
Amazing. I cannot believe how much we had to talk about. We're almost out of time. We got to go, but we'll be on again in a couple. I'll have you on again in a couple days. Thank you for all the weekend work, the night work. I love having someone who's on top of this 24/7. It really helps everybody. So thank you, Logan.
Jack Bauer, Econ 24/7, baby. Me and Chloe are going to do it. Yeah.
You've got Chloe on your side. We're all good. Oh. All right. Thanks, Logan.